The market thoughts right now, Julian. Is this something, the beginnings of a deeper decline for stocks?
We think you're sort of, call it sideways to lower over the near term, simply because, in our view, the market is not pricing in enough political risk here.
What type of political risk?
Well, I think when you look at the U.S. and China trade tensions, the market seems to think that there's going to be a deal done, and we think eventually there will be. But the probability that it may get more tense before it gets less tense with the VIX at 15 doesn't really discount any of that.
It's a hard thing to predict the future. We know this, but you do get paid to forecast for these things. So how long in your mind does a trade conflict with China take before it resolves itself?
Well, I mean, there's talk that it could be years, and it's a process. But the conversation between Presidents Trump and Xi, we would expect to see some progress over the summer. But the bigger question is where's the Fed going to be if, in fact, these trade tensions do cause reverberations in the economy, and we see slowing. Right now, second quarter GDP is projected at only 1.2%. That's not going to be a great thing.
It seems as though the Fed speak that we've heard, and we'll get a lot more of it today and in the coming days, has put the Fed in a neutral position. They don't look like they're going to raise. They don't look like they're going to cut. So is the Fed really a factor at this stage unless there is a big catalyst like U.S.-China trade?
The Fed is absolutely a factor. You go back to the beginning of the year when the Fed basically went to the sidelines. It helped the equity markets out tremendously. We actually think that the Fed is assessing the risks. And yes, they have said that neither a cut nor a hike is likely in the near term. We think they're very cognizant of the fact that trade could drag on the economy. We actually think that ultimately later this year they'll cut, whether it's for insurance purposes or for, to really help stimulate an economy that's weakening because of trade tensions.
There have been a lot of casualties in this market given the U.S.-China trade negotiations right now. So are there places, parts of the market that you consider to be poised to rebound the most if a deal does get done?
Well, we'd actually started thinking of it in a sort of a less risky way. What we like right now particularly is healthcare, because if you think about it, healthcare actually works in a more politically volatile environment. What we saw yesterday was the Republicans and the Democrats probably aren't going to get a lot done this year legislatively. That works for healthcare on balance. As well, healthcare is immune to the goings-on in the international world. And if you look at the fourth quarter of last year, during the market turmoil, healthcare outperformed. We think healthcare is going to work here.
Just a few moments left here. Are there places you would stay away from in this market?
Yeah, we think consumer discretionary stocks, a lot of which have really run a long way on the strength of the first quarter GDP, on the strength of the consumer really sort of hanging in there, which we think does continue. But those have gotten ahead of themselves, particularly if they disappointed on their earnings reports in the first quarter.